In the United States, the mechanism of money creation is often misunderstood as a neutral process that affects everyone equally. However, the reality of the American financial system is dictated by what economists call the Cantillon Effect. To understand why new money disproportionately benefits the wealthy, we must first look at the source, the Federal Reserve. When the Fed engages in monetary expansion, often through a process known as quantitative easing, QE, it doesn't simply print physical cash and hand it to citizens. Instead, the Fed creates digital reserves to purchase government bonds and mortgage-backed securities from primary dealers, which are essentially the nation's largest commercial banks and institutional investors. This is the exact point where the wealth gap begins to widen. Because these large financial institutions are the first recipients of this new liquidity, they have the first mover advantage. They receive the capital before it has had the chance to circulate through the broader economy. At this stage, the purchasing power of the dollar is still high because prices for goods, services, and assets have not yet adjusted to the increased money supply. These institutions and high net worth individuals, HNWIs, use this cheap money to aggressively invest in yield-bearing assets such as the S&P 500, tech stocks, and commercial real estate. As this massive influx of capital pours into the markets, it triggers asset price inflation. We see the stock market reach record highs and housing prices skyrocket. For the top 10% of Americans, who own approximately 90% of all stocks, this is a period of rapid wealth accumulation. Their net worth grows exponentially, not necessarily because the companies are more productive, but because the currency used to value those assets is becoming more abundant and less valuable. This creates a wealth effect for those who already own property and portfolios, while those without assets find the American dream of home ownership increasingly out of reach. The tragedy for the average American Main Street consumer lies in the lag effect. By the time this new money trickles down through the economy in the form of slightly higher wages or government stimulus, the damage is already done. As the money supply expands, it eventually leads to a rise in the Consumer Price Index, CPI. By the time the working class receives their share of the new money, the cost of living, gas, groceries, rent, and healthcare has already risen to reflect the devalued currency. In essence, the poor and middle class are forced to pay tomorrow's prices with yesterday's purchasing power. Ultimately, the structure of the U.S. financial plumbing ensures that those closest to the printing press, the banks and the government, benefit from the low prices, while those furthest from it, the salaried employees and savers, bear the burden of inflation. This is not a conspiracy, but a fundamental function of modern fiat currency systems. It acts as a hidden tax on the productive class and a massive subsidy for the asset-owning class. Understanding this dynamic is crucial for anyone looking to navigate the American economy, as it highlights a singular truth. In an era of constant monetary expansion, holding cash is a losing strategy, while owning assets is the only way to stay ahead of the curve.